everyone! Today I'll be covering Chapter 11, which is Financial Statement Fraud. To start things off, I want to introduce you to a couple different frauds that were very prevalent in our time that you've probably already heard of being in business school. So the first one will be Enron. So Enron was one of the biggest financial statement fraud that we've seen. Enron happened in 2001, and what they had done with their financials was that they had overstated their revenues, they had overstated their assets to make their books look better. During the course of this time, when they were doing well before the fraud happened, their stock price was at $90 at the high for that year, and then it decreased to less than $1 once the fraud came to light in a matter of days. Enron ended up filing for bankruptcy, and it came out that the former CEO and the current CEO at that time were being charged with the fraud. One of those individuals, that was the current CEO, he actually passed away before he was sentenced, so he didn't go to prison for this. But the other one, Jeff Skilling, he went to prison for committing fraud with Enron. Along with Enron, who went down with them was Arthur Andersen, which was their auditor. They were convicted of obstruction of justice through destruction of evidence during this time. It actually came out that their charges were overturned, but the damage was already done, and they had already lost their reputation, so they had already gone under. The next fraud that I'll talk about is WorldCom. This was much, much more massive. They were also audited by Arthur Andersen, so we see a fraudulent auditor working with multiple companies who end up having financial statement fraud. In WorldCom, their assets were inflated by $11 billion. It's huge. WorldCom ended up filing for bankruptcy, and both of these frauds were what ultimately had brought Congress to enact SOX 2002. To start, we're going to cover the problem of financial statement fraud. The efficiency, liquidity, and resiliency of stock and bond markets, they depend on the ability of investors, lenders, regulators to assess the financial performance of businesses. These individuals, they use financial statements to assess the standing and the performance of the business, and then they would recommend for people to invest or divest, and then whoever's using those statements uses it to make those decisions. Generally, GAAP financial statements are prepared with integrity, and they are made to present a fair representation of financial position, but financial statement fraud can affect assessment of companies and cause huge losses, and when this happens, then people lose trust in the market. So next we're going to look at financial statement fraud in recent years. Misstated financial statements and cooking the books, inappropriate executive loans, and corporate looting. So this is all the management of the companies. Chapter 11 really is the first chapter talking about management fraud. And so what we see here with financial statement fraud is that it's pretty much always those in management, because they're the ones who have the ability to make these changes, to make these adjustments, and they're the ones that think that they're going to get away with it. We saw insider trading scandals, we saw IPO favoritism, we saw excessive CEO retirement perks. There could be exorbitant compensation with cash and stock options. So stock options are something that we'll talk about a little bit later, but they are a big key issue here. And then we also have loans for trading fees. A key thing that we see is backdating of stock options. So I had just mentioned them before. Executives, they can get stock options, which most of you guys know what this is, but I'm going to explain it anyways. So stock options give an executive or anybody in the company that's issued them the option to buy stock, exercise their options at a certain price that's stated on the options at any given time within the dates of the options. If they're issued options at a low price, when the stock is high, they can exercise the options and turn around and sell them and make money. So that's something that we commonly see, but we see with these frauds that there were executives that were backdating stock options. So they were making it look like they were issued earlier, but they were just issued when the company was really in a high place so that these executives could come and turn a profit as fast as they could. The next thing that we'll talk about is why these things were happening. So we've discussed some of the issues that create financial statement fraud. So now we're going to talk about why. And the why, we're going to bring it back to the fraud triangle. So first we're going to start with the pressures. So the pressures to commit financial statement fraud include if the company is going to see a financial loss. An executive or a management person may not want that to happen because it'll make them look bad. So that's a pressure for them to commit fraud and change the books and change the numbers to make it look like something that it's not. Next, we can see failure to meet Wall Street's earnings expectations. Investors in Wall Street are looking at people in the industry, how this company has performed before, and they're making earnings expectations and saying this is what it's going to look like, and getting people to invest if it looks like they're going to do well. So if Wall Street's telling people that this company is going to start performing better and they're not, then that puts pressure on management to ultimately commit these kinds of frauds. Next could be inability to compete with other companies. We see issues where there's an industry and a lot of companies are doing well, but there are specific companies that aren't doing well, and that's when you see them try to kind of pick up the pieces and jump up to where they should be in their industry, and it's fraud. And then the last form of pressure that we see is the executive compensation in the form of stock options. So moving on to the next part of the fraud triangle, we have opportunity. Opportunity in the fraud triangle could look like a weak board of directors. So if there's a weak board of directors, this executive may think that they're not going to get caught, that nobody's going to uncover what they've been doing. Next, we have inadequate internal controls. So if they think that it's not going to come up in internal audits or any system checks that are out there, then they believe that they can get away with it, and that's an opportunity for them. Once they see these opportunities and they've already felt the pressure, then that's how they're going to commit the fraud. And so then we move into the rationalization portion. The rationalization portion, executives find themselves rationalizing through means such as, I need to protect the shareholders, I can't let the shareholders down, or I need to keep the stock price high. Wall Street has these high expectations of how we're going to perform right now, so I need to do this. And this is how they rationalize. Sometimes they even think this will be offset in the future, so it's okay to do it now. One way that I have seen this recently is in Dr. Barton's advanced accounting theory class, and we had to watch a video, and it was about ethics, and there was a specific situation where management was asking the CFO to commit fraud by pushing expenses to the next period, pulling revenues back so that this quarter would look great on the books for them. He kind of convinced him, saying, well, it's going to even out in the end because then that stuff won't be there next quarter and it'll all even out over the whole year. And so this is kind of how they rationalize things and loop people in, bring people into their frauds, and convince themselves that this is okay. Once we've moved on from the fraud triangle, then we can look at the perfect fraud storm. There are 9 categories to the perfect fraud storm. The first one's going to be a booming economy. So like I said before, if the industry is doing great things but this specific company is not, then they might see a reason to do it. They might feel that pressure. Next is going to be decay of moral values. It was mentioned in the book that recently cheating in school has become more rampant. This may be a decay of moral values that are letting people rationalize this better. The third thing that we're going to look at would be misplaced incentives. Again, we see the issues of stock options where they're being issued to executives and they can turn a quick dollar off of them. The fourth section of the perfect fraud storm is going to be high analyst expectations. When firms are compared to each other and the other firms are seeing high performance, there's expectation in the market and by management that the firm needs to perform better. Next, we're going to move on to the fifth part of the perfect fraud storm, which is high debt levels. Around the time of Enron happening, derivatives were a huge thing, and they were a huge hit to Enron because they ultimately increased their liabilities from $1.8 billion to $100 billion, which is insane. High debt levels are perfect fraud storm. Next, we're going to see the focus on accounting rules rather than principles. When we have accounting rules such as GAAP in the United States, loopholes can be found, and when loopholes are found, then things get a little tricky. The next part is lack of auditor independence. The auditors became preoccupied with consulting with companies and their clients, and they would do more consulting work rather than auditing and kind of coach them as to what they needed to do, rather than being a set auditor saying we're going to look and see what we can find. We saw this with Arthur Andersen. They were doing this with Enron, and when Enron went down, Arthur Andersen went down. The eighth part of the perfect fraud storm is going to be greed. Greed is a huge issue with financial statement fraud. Nobody wanted bad news. Nobody wanted to see the company go under. They wanted to have all this money, and this is where we see more pressure. And the last part is educator failures, and I think that this class kind of touches on that a lot, that ethics training isn't supplied to students as much as it should be, and students aren't being taught about fraud. Back when Enron happened, this was even bigger of an issue, but now we see more of this happening, and we have ethics and fraud training at work. We don't necessarily have it in school because this isn't a required class. I feel like it should be, because I had no idea most of this stuff that we're learning this semester. Moving on from the perfect fraud storm, we're going to talk about the nature of financial statement fraud. Intentional deceit. There's always intentional deceit in financial statement fraud, and there's attempted concealment. So attempted concealment can come in ways of falsified documentation or collusion among employees where they're working together to make sure that people aren't going to find out about this. One thing to mention is that red flags and symptoms of these frauds don't always mean that there definitely is a fraud. There can be usual accounting errors. There can be issues with systems. Next, we're going to look at some financial statement fraud statistics. It's difficult to measure frauds because not all of them are detected, and financial statement fraud is one of the most rare forms of fraud to happen in these businesses. One way that the SEC tracks financial statement frauds is they have these things called AAER. I'm just going to call them AIRs. It's Accounting and Auditing Enforcement Releases. This is when a fraud occurs with a publicly traded company, then there's an enforcement release that shows everything that happened, the business, the amounts, who was involved, so that people can study and try to find ways to prevent this in the future or better ways to detect that this is happening. So there were multiple studies that were listed in the book. I'm just going to touch on a couple of them. We have the COSO study that was from the period of 1987 to 1997, and during this period there were 300 financial statement frauds that resulted in these AAERs. They determined that the average fraud lasted 2 years, so this stuff is happening little by little over time. And what they're seeing in these frauds is improper revenue recognition. They're seeing overstatement of assets. They're seeing understatement of expenses to try to boost their profits. The average fraud during this time period was $25 million. In 72% of these cases, there was actually, the fraudster was the CEO. It's typically executives that we're seeing committing these frauds. 36% of the companies that were issued these enforcement releases actually ended up filing for bankruptcy in the end. A lot of these saw that there was no audit committee, or that the audit committee only met once per year, or that there were insider board members. And it's very, very, very important to make sure that board members are independent so that they can analyze things properly. The next one that we'll talk about, there was an SEC study that was done based on section 704 of SOX, and it was from the 5-year period from 1997 to 2002, and this one saw 515 AAERs. In the previous study that I talked about, there were 300 in a matter of 10 years, and in this study they saw 500 in a matter of 5 years. These frauds were increasing by huge number. In this, it was the same kind of situation. CEOs, CFOs are the fraudsters. They're improper expensing, improper revenue recognition. So we're seeing the same kind of things over and over again. So then that makes you wonder, what are the motivations for people to commit these frauds? We see a few different things, which could be company pressure, which we've talked about, market pressure, investor pressure, bonus pressure, and then ultimately there's the pressure of fail or cheat. So these executives could look at it as, if I don't do something, then either my business is going to fail, or I'm going to be fired, so I'm going to be a failure, or I can try to cheat and try to get away with it, and then things will all be happy. That's what they think. Moving on from motivations for fraud, we have a framework for detecting financial statement fraud. It is extremely difficult to detect these kinds of frauds. In order for these frauds to be detected, the auditor or person reviewing it has to understand the business thoroughly, because if they don't understand the business or the industry thoroughly, then they're not going to understand where there are little changes that may be off or may look like they're not right. If you don't understand the business, you're not going to find those things, or you're not going to be able to say, well, that's not how we're supposed to look at that, or that's not how that's supposed to be recorded. So there has to be a very thorough, deep understanding of the business. Next is they have to understand the organizational structure. Who's in the company? How do they work together? How are they related to each other? How do they know each other? What are their pasts? So you have to understand the organizational structure of the company. Next, we have strategic reasoning. Strategic reasoning would be anticipating potential methods of engaging in concealing fraud. So this is where the auditor has to look at things from different perspectives to kind of see where these frauds could be happening and how the person committing them would be concealing them. So this is typically done by external auditors, but internal auditors can work through strategic reasoning as well to try to make sure that things are running smoothly. To look more deeply into strategic reasoning, we're going to talk about a few different things. The person committing the fraud, they're anticipating the audit happening. So they're looking at it from the standpoint of, okay, someone's going to be auditing me. What are they going to be looking for? And I'm going to try to conceal it around that and try to avoid them finding it. And then the auditor's looking at it from the side of, how could they be hiding it from what I'm going to do? So this becomes part of this game theory that the book mentions, which would be predicting behavior based on an individual's best response given motivations or beliefs regarding likely behavior of the opponent. So this is where you see they're kind of looking at, well, this one's looking at, they could detect it from me doing this, so I'm going to do it this way. And then the auditor's looking at it from, okay, they're thinking that I'm going to do this specific audit procedure, so I need to find a different audit procedure to do that might detect something that they thought that they had hidden from me. These frauds end up being cooked up in a way that the typical normal audit wouldn't detect it, because the executive that's committing the fraud knows these audits that are happening every year, and they know the ins and outs of what's requested, what's looked at, and kind of the procedures that the auditor goes through. The auditor then has to look at things from the perspective of the fraudster and say, how could I hide these things? And then they have to do their testing based on these findings. So another way, besides them kind of changing their test to something that they wouldn't typically do, would be detection through comparing performance to the industry or prior periods. So they may just be looking at the financials and say, oh, this looks great, but whenever they compare it to the year before or the quarter before, they say, I wonder why there is a change from this period to this period of this much, or I wonder why last year we didn't see this big of an increase and now this year we're seeing this big of an increase. So they're looking at comparing prior periods, and then they can also look in the industry and say, in this industry, these things aren't happening, so why are they happening in this company? And that can kind of help them uncover the fraud that's happening. So then next we can look at non-financial performance measures. So these could be the business has a ton of locations closing, but for some reason their profits are higher. So that would be a non-financial measure where they could look at how many locations they had in the prior year, how many they have this year, and then say, well, what's the reasoning behind the revenue increasing when you have locations closing? Or if they're reducing the number of employees, how are you making more money with less people? And just digging into non-financial measures such as that. So moving on from detecting the fraud, we're going to look at exposing the fraud. We have the fraud exposure rectangle. First, we're going to look at the management and directors. So these executives are committing fraud on behalf of the organization. They're not working against the organization. They're not trying to bring the organization down. They're trying to help the organization in their mind through their rationalization. It helps to expose them by looking at these executive backgrounds. Have they been involved in something like this before? Have they been part of an AAER that was released by the SEC before? So we can look at all of these kinds of things and see, what do their backgrounds look like and what might motivate them or put pressure on them to commit these frauds. So then we see an influence in making organization decisions. So managers have an influence on the organization that they're working in. That's why it's vital to have independent boards of directors and more people at the executive level to make sure that one person's not in charge and is just able to change things however they want. So the next part of the fraud exposure rectangle that we're going to look at will be relationships. So we see relationships with others. So have relationship with financial institutions. So there was one example given where a company's executive had gotten a loan from a bank in another state, and they were like, that's weird. Why do they need to have a bank that's not located where they are? Strange, right? So they actually found out that the executive had a personal relationship with one of the people at the bank, and so they were able to send falsified confirmations when the auditors were getting bank confirmations, and they were able to falsify those, and so this kind of came up as like an issue. And then we move into the relationship with related organizations and individuals. There's a whole arm's length rule of how things have to be done, and we have to look at unrealistic transactions with related parties. So why are they having this specific transaction that's crazy huge when it doesn't seem like it's really related to the business at all? So looking at the relationship with related individuals is super important. Next, we see the relationship with auditors. So a change in auditors can be a big sign of fishy activities, and publicly traded companies actually have to disclose when they change auditors and why they changed auditors. So this kind of helps to determine if it might have been for a reason that wouldn't be fraudulent, like the auditor had increased their fees, and so when the auditor had increased their fees, they decided that they didn't want to work with them anymore. And that stuff's fine, but we just want to make sure that there wasn't something in that relationship that would lead to a fraud happening. Next, we see relationship with lawyers. So if there's a change in a legal firm, that's a huge cause for concern, because the legal firm is advocating for their client, and if they decide they can't work with them anymore, there might be something fishy going on there that they can't stand up for them anymore. Then we see relationship with investors, knowledge of shareholder numbers. So how many shareholders do they have? Are they owned by a small group of people? Are they owned by a certain subset of people? To know what kind of investors they have, then they can indicate whether there's pressure on management to commit fraud. And then we have relationship with regulatory bodies. So like I said before, they can know if there are any enforcements against the company. Did they file their statements on time? Are they keeping up with the regulations of their industry? So these relationships all contribute to the fraud exposure. Next, we're going to look at the organization and industry. So the organizational structure can be very telling as to whether there are opportunities for fraud to occur. What subsidiaries they have, how many executives they have, what their board of directors look like, any of this stuff can contribute and tell, where there are odd relationships that maybe shouldn't be there, where there are fishy things happening to help expose. And then the last part of the fraud exposure rectangle that we have is going to be the financial results and operating characteristics. So as we had talked about before, financials should be compared period over period along with those in the industry to make sure their numbers are where they should be. They can look at non-financial measures, as I mentioned before. They can see if someone's reporting high inventory and they have a small warehouse. Well, how are you keeping up with that inventory when you don't have room to even store it? So these are like non-financial measures that they can use to expose the fraud. First, we went over a couple examples of financial statement fraud that were really huge in the beginning of the 2000s. Then we looked at the problem of financial statement fraud and where we have seen the frauds in the recent years. We moved on to why frauds were happening, why these problems were occurring. We looked at the perfect fraud storm that allowed these frauds to occur. Then we saw the nature of the frauds that was happening. We then moved into some statistics about the fraud and studies that were done based around these frauds, into motivations for committing financial statement fraud. We looked at how to detect it, and then we looked at how to expose. So even though financial statement fraud is very rare, it's still good to know about it so that you can be on the lookout for things like this. Even though it's very hard to detect, it's very hard to expose, and it's very rare, we all need to be educated on this. I feel like every business student should be educated on this topic, and I've had fun talking to you guys about it. Let me know if you have any questions in the discussion board, and have a great day or night whenever you're listening to this. Bye!